entertainment, insights. Don't take life too seriously. Welcome to Brainsky Unleashed. Welcome to the program. Today we have Ryan. Ryan Tansom he's an amazing guy. He's an enigma, actually. So most people may not know him who may be listening to this or watching this live, even though it's recorded, but that's just me being an idiot as I begin the program. He's a podcast host. He's got over 340 interviews with over 470,000 downloads, which, by the way, is wildly impressive. Founder of Kona, we're going to get into that. The intentional growth framework, intentional growth training, been a part of over 24 deals. He's helped build a family business, the EVP of a family business, led a turnaround and an 8-figure exit. Big player, big time. Father of twins, but what we all really want to know is, can you make an omelet?
I can make an omelet, but I cannot do pigtails or French braids.
You know, I too have twins. My twins, I have a boy and a girl. I can do my son's hair. He looks like
come on. How long is his hair though, Thomas?
But that's the thing, is like mine. So I can make him look amazing. But when it comes to my daughter, I am just bad dad.
All right, because you digress right off the bat. So before the girls went to kindergarten, my wife was laying on the bed with her head hanging over, and she had me practicing a ponytail on her, and then I was doing my girls, and they have these little teeny binders you do that like are so, Stacey, you probably just laugh because you know exactly what I'm talking about. They're little binders, and I have huge hands. So I get the binder and I go like this and go, so my daughter was like, ow, 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 the first day of school. And then she just looks at me. She's like, after 3 tries, she's like, Daddy, I think I'm just going to wear my hair down. And I was like, come on, I'm trying.
So there you have it. He may be wildly successful. He can literally generate millions, if not billions of dollars for his clients. But like me, man can't do a girl's hair.
Yes. Amen to that.
So again, Ryan, welcome to the program. We're very happy to have you here. And Stacey is joining us. Stacey, my partner, and full disclosure, Stacey and I have the ability to help anyone out with working with Ryan and his services. So I will follow this up at the end and remind everyone that if you are in fact interested in working with Ryan, come to Stacey, come to myself. We are happy to help you. We can help change your lives because Ryan absolutely knows his stuff. So Ryan,
and then Thomas, before you even keep going,
yes,
I'll say that also that the partnership that we have with you guys is the partnerships that we've been looking for 10 years as I've been doing this, because it actually is what makes the whole picture work. So we'll get into that, but it takes both of our parties to actually complete the picture. Which
this is what love is all about. Thank you. You're absolutely right. Okay. So I'm going to get us kicked off here with, I mentioned Kona, which nobody knows what in the world that is. Can you just tell us what is yes. Kona? And more importantly, as you explain Kona, what makes it different from competitive providers? Because there are competitive providers out there.
Do you want to the more literal answer, like what is Kona actually, like the actual name, or just in general for our company?
You know what? It's a podcast. We've already talked about eggs and hair. So let's go with what is it?
How about this? I'm going to save that for the end just to keep everybody's anticipation going.
There you go.
So if you actually, and it's just not going to be as cool as everybody thinks. But so Thomas, what Kona is, so we are a business. We've been around since the inception was in 2019. And that was after, oh my gosh, was it 5 years of me doing a bunch of consulting and a bunch of other, as I call it, the 1.0 version of Kona, after we had sold our family business and exited in 2014. But what Kona does, we have 2 buckets of service. One is education, and it's called the Intentional Growth Academy, and it's in person or online. And these are boot camps that are based on 5 principles that help people view and run the company like a financial asset. The whole goal is have a lot of fun, create a lot of wealth, and make an impact, and actually make the journey of being a business owner worth it. And that could be different for everybody. So it's education that ties into how do we actually do that. And then the education that's how the company actually started. And we've had 550 entrepreneurs go through the program. And people kept looking at us and looking at principle 4, how we talk about growing value. And they're like, what are you doing there? We're like, we need that dashboard. We need that plan. And so people, I said that the market forced us to build out our fractional CFO services and then also our financial dashboard offering. So those kind of two are the way to think about them is the dashboard is the do it with you. And then the CFO service is the do it for you. But really what it is just after people kind of shift their mindset, like, hey, this company is an asset and I can grow the value of it and actually create a lot of wealth. How do I actually manage that process? Through the financial dashboard or the CFO services, we're really helping people build that roadmap. So that way people can actually have a context to the goal and how their decisions today are actually getting them closer to that goal. So kind of education and services, and the people with like lifetime advisors are our perfect partners, because what we're doing is we're helping people bring visibility into the future cash flows and valuation of their company. But what about everything else, like estate planning, all the rest of their assets, the rest of their cash flow? How does the whole picture fit together? That's where Lifetime and Arcona really help each other out, because between both of those pieces, it's kind of like you got complete visibility into the future of your plan and where you're at.
And you sort of mentioned it by sort of dancing around it, but it is literally treating your business as an asset. And most small businesses don't actually do that, and they don't know how to do that actually. And that's where you come in.
Correct. Yeah. And that's what I've found out over 10 years, because, and just some data points behind this. One is for the people listening, and if you're a business owner, I ran a $21 million business with 115 employees, and I call it was a lifestyle business. And my definition and Arcona's definition of a lifestyle is we were solving for annual cash flow. So yeah, it was $20 million in revenue, but by solving for annual cash flow, it's how much cash can we suck out of this machine through salaries, perks, distributions, and other things. Not thinking, hey, if I invest in an ERP system, launch a product or service, or hire a key executive, that's an investment. How does it grow the equity valuation of my business? You see how there's just completely different ways of thinking. And so we had that solving for annual cash flow. And then the reason I think the biggest pain point is most privately held business owners, and I'm saying like anywhere from a couple million to a couple $100 million. If you didn't come from Wall Street or private equity, we didn't get this formal education.
No.
Like, how does normalized EBITDA work? How do multiples work? And then how do I focus on increasing EBITDA and increasing the multiple while I run the company instead of just guessing for 30 years? So there's this whole, we want to take the guesswork out of it and then actually help people view their business this way, because I think it'll change their decisions and how they think about their business every day.
So let's talk then about the market itself, right? So your market, your client base, what is it? What do you think is like your ideal client? I mean, is it a business who, it's John and Jill and they have a pizza shop, or maybe they have two pizza shops, or is it the $5 million to $10 million revenue range? I mean, what is it that you typically feel would be the best fit for your service?
So I'll answer that in two ways, but before I'm going to respond with a question is, does the pizza owners or is the $100 million company owner, they all care about having an asset that is worth something and that grows in value, right? Whether whether it's an idea or whether they're year 2 or year 20, we have something that we own. We want it to grow in value. And hopefully, if people decided to take out a mortgage and personal guarantee all the working capital and the building and all the sacrifice of time, money, energy, pain, you want to make it worth it to have more freedom of time, more freedom of wealth, so you can do what you want, when you want, for as long as you want. And the only way you can do that if you have a company that's running itself, that kicks out cash, that's growing in value.
So I'd say that's running itself. Now, can you define what that even looks like? Because I'll tell you what, there's probably a lot of small mom and pop shops. Maybe they're a few 100,000 in revenue, or maybe you've got some mom and pop shops that extend up into the 1 to 2 million range. Although I think 2 million at that point, they're pretty well aware of what is running itself and is not, but the smaller ones may not. What is it when you're actually saying running itself? What does that mean to you?
Love it. And I'm going to tackle that. And there's a very specific way I want to tackle that in just a second. But before, I want to go back and answer your original question about what is our ideal client. Because I talked about everyone's not a very specific answer, but it is a mindset. So there's two ways to answer that question. One is the mindset, and the other one is the actual structure of the business. So the first is a mindset, like whether you're looking at starting the business, taking a jump out of corporate America and buying a company, like if you buy something, don't you want to know how it's valued and how to grow the value? So it's
Huge.
like, yeah, and that's where the education that we provide is applicable for anyone for the most part. But whether it's aspiring entrepreneurs, people that have a couple $100,000 pizza shop or a couple $100 million professional services or manufacturing firm. I mean, all those types of companies have been through our program. The common trait, though, Thomas, is they're not backed by professional money like private equity or investors. Because if you think, so venture capital, they're venture capitalists, they place 20 to 30 bets in startups that are not going to, make cash flow for 20 years, 10, 20 years. That's their model. Private equity are professional institutional investors that buy cash flowing companies to grow them and sell them for a profit. So the infusion of venture capital, private equity mandates, like if you and Stacy took on PE or VC money, let's say it was me that gave you guys $5 million, I want to know, when do I get it back and what's the return? It's baked into the business plan. So now let's take the rest of the world, which is the privately held businesses. And there's 6 million privately held companies that have employees in the US. They employ 130 million Americans. They didn't get that mandate, right? They got the mandate of like, I want to not work for the man or the woman, and I want to have my own job and my own freedom to do what I want. They have a niche, whether they are good at selling something, doing something, making something. They got good relationships. So they start their business, they grow it over time. And they did what my dad and I do, which is kicking out the cash. Mm-hmm. But they don't go, hey, what's this thing worth? Because when and how can I monetize it? So there's the psychographics of like, hey, like everybody should want this. But then there's the how do we work with people? And then there's the dashboard and CFO services where there's kind of a threshold of size, more of like, hey, can they afford it? And then can they afford to reinvest in their business to grow the value? But back to some of your question of like, how do we have a self-running company, Thomas? And how do we, okay, great. This is how, like, these are the different potential clients that work with us, but what do we do about this? And how do we get that freedom and that self-managing company? It comes back to this phrase that I have had hundreds of people call me over the last decade and say, they call me up and say, Ryan, I want out. And for years and years, I would try and solve their problem. Like, all right, Thomas, let's get you out. And then I'd like try and build plans or talk to people or like, I mean, whatever it would be. And then I was like, after years of that, I'm like, what the hell are we solving for here? Does Thomas even know what the goal is? Like, and then I started asking people, what's your goal? And what I found out is when I hear people now, it's what do they want out? I hear, I want out of the employee issues. I want out of the personal guarantees. I want out of the supply chain issues, inflation issues, interest rate issues, political issues, and blah, blah. And I say, well, Thomas, that's the job of a CEO. So that's your job. No one typically calls me up and says, oh my God, I'm so sick of my mailbox money where I clip the distributions while I sit on the beach and, Thomas runs my company. That is your asset.
So to sum it up, you're basically saying that to you and the way in which you define it and the ability that the capability that you're providing a business is to give them the ability to collect that mailbox money while the business, in fact, can run itself. Is that correct?
I would say yes. And the concept that I was laying out of the job versus the asset. Mm-hmm. So like I have Apple stock, Stacy, Thomas. I don't know if you guys do in your 401k or your retirement plan. I do. I don't work at the Genius Bar. Do you guys?
I visit the Stacy actually needs to visit the Genius.
Stacy, you got a Saturday gig is my thought, right? Well, and the reason I say this is like, we don't have to work at the assets we own. And somehow privately held business owners, we got this narrative. A lot of the baby boomers, as they started out, they took the risk. It's like, we don't have to have a job at our company that we own. And private equity and ESOPs, they're structured that way. Private equity is predicated on raising money from other people, buying companies, having other people run and execute the plan, and then selling them while they sit in a boardroom. So like, every single business owner listening in that's a privately held company can do the same thing if they have the right goal. And revenue is not the right goal, because I owned a $21 million company that lost $940,000 in 2009. And if we would have sold the business, we'd have owed the bank $2.5 million. So the target equity valuation is the goal that'll actually align everything. And then, Thomas, there's an ability to say, when can you hire the right executives along that path? So you can still afford your cash flow personally while hiring that person and tying that executive to the long-term valuation goal.
So I'm gonna take a step back because you mentioned some statistical market data, which I think is actually important. And you glazed over it, but I want to actually kind of bring it back to light because you mentioned how many businesses there were in the United States. What was that? What were those statistics?
So I'll give me a minute because I'll break this down. I've memorized these things. It's so fascinating to me. And this is actually the data that got me set on to this decade-long journey, because I was like, this is a big problem. This is not like, hey, our Kona or Thomas and Stacy and Ryan's cool little, venture is in. There are 330 million Americans.
Okay.
Let's say 100 million of them are older babies. Okay. So now we have, let's say it's roughly, for easy numbers, 250 million Americans that are working Americans. There are 27.7 million entities in the US. Only 6 million of them have employees. So think about gig workers or freelancers, 1099 contractors. So therefore, there are only 6 million privately held entities that employ 130 million Americans. That's half. Not Meta or Amazon. I'm talking to the people listening in that have a manufacturing firm, a professional services, a SaaS business, an e-commerce. Like, we're running the company or the country. So then we have only 21,000 companies that are privately held over 100 million in revenue. That's it in the US. They employ 56 million Americans. Isn't that crazy?
So let's drill down a little bit further for a moment, which means that you have all of these small businesses, and how many of them are currently your clients? 400, a little over 400.
Yeah, it's like, a rounding error on the very end.
Right.
It's
So a
ridiculous.
rounding error are currently your clients, which means that there's at least a high probability that the remaining, close to 6 million,
Everyone, pretty much.
I'm really terrible with math. They're all making the same mistake and they don't know it.
Yeah, and well, let's agreed, and let's put a pin in that. And as I finish these numbers, it'll become even more obvious. Is that so? Over 100 million, those 21,000 companies, that's 0.3%. That's it. So then you have between 5 million in revenue and 100 million in revenue. There's only 350,000 companies, and they employ roughly 32 million Americans. So that is literally 0.4, or I'm sorry, 4%. I think 4% of everybody's above 5 million in revenue. 94% of the companies are below 5 million in revenue. That means there's 5.6 million companies below 5 million in revenue. They employ 30 million Americans. I could get into a whole geek session as far as like underneath 5 million in revenue. There's generally, and I should say typically, not enough cash flow to actually support the transition to the next generation between debt, taxes, and then reinvestment and distributions. The math just doesn't work. So like, I think it's our job as providers to educate and then help these people grow the value so they can facilitate the transition and make the whole journey of everything they've done for decades worth it.
So
I have a question.
Go ahead, Stacy.
I just like, what questions would we be asking a business owner? They do not realize they are missing this big piece of the puzzle to transition, or
They have
to
no
not.
idea.
They have no idea. So are there questions that we can be asking business owners that they should be asking themselves? They just don't realize they're missing it.
Yes, there are questions to be asking. And I would say, Stacy, that I knew there was something missing over 10 years ago. I didn't know what was missing. And I think that most people could probably relate to that. I mean, I might be wrong, but like, what I mean is, like, if you asked me, Stacy, hey, what's our Kona worth? And what's your 20, because I have a 2030 goal. And like, if I can't explain to you what it's worth and what I want it to be worth, I'm guessing. And business owners know this in their heart and in their soul, because they know, they look at their Charles Schwab account of, diversified ETFs that they haven't been funding for 20 years. And they wish it was 2 million, not 200 grand. And the 200 grand is collateralized against the working capital and inventory in their company. And then you go, hey, what's your company worth? That's doing 4 million. They're going,
Nothing.
No idea.
I don't know.
So there's nothing worse than feeling like you're. I had a guy came up to me. I speak a lot for Vistage. It's a national peer group mastermind. And this guy walked up to me last week. True story. 35 employees. He's been doing his job for 20 years. He's like, Ryan, I'm so exhausted. And then he goes, I want out. And he saw my 3-hour workshop. And I said, what do you want out of? Not, I'm not answering that question. And he goes, okay. He goes, I kind of want out of both. But then he started describing it. He goes, I'm guessing. I'm literally investing in things, knowing, have no idea what my company's worth. I'm sick of juggling cash flow. I'm kind of bored. I don't like my industry anymore. And he goes, he doesn't even have enough data to make a decision. So like, think about this. When you're exhausted, all you want to do is get out, right, of that situation. But if you don't have the data to make an intelligent decision to say, hey, I want to get out of my job or my asset, and you have no idea how it's going to impact your retirement, like, it's terrifying. And what happens is, Stacy, these business owners know this, but what I've seen over the last 10 years, there's not people that are readily available walking around saying, hey, by the way, it's pretty simple on how to value a company. You're like, what the hell is exit planning? People really don't know. Then they don't know how valuations work. It's too complicated. So the business owners put their head back in the sand instead of realizing that the intrinsic fundamental value is based on the risk of the future cash flow. That's it. Like, so there's a way to actually focus it. But Stacy, back to your point about the questions, one question that I have never had anybody answer yes to from thousands of people was, I always look at my watch and I'd say, okay, well, it's August 1st, 2023. Thomas and Stacy, let's say you were a business owner. I'd say, okay, let's say kind of M Ryan.
Yeah.
In August of 2024, middle of the year, I always ask people, raise your hand if you can tell me what your cash position in the company will be with your estimated taxes, taking the distributions that you'd plan for. If it was 20 grand on top of your taxes, on top of the cash position, and the amount of money that's left back in the business after all that, let's say it's 500 grand, that is tied to a plan that has the valuation in 5 years that you want. Zero people have raised their hands.
That's amazing.
Even people backed by private equity, which I just wonder, like, what the hell?
That's kind of shocking. I mean, there's got to be somebody at the firm that can actually answer that one.
Or they're going to make it up and with a spreadsheet.
Right.
That's awesome.
So I think, Stacey, it goes back to visibility. It's visibility, and it's the understanding of like what creates value, like cash flow, which is the normalized EBITDA, and de-risking that cash flow, which is the multiple. So what creates value? And then can I see, if I do these things, what would happen in 1, 2, 3 years based on my decisions? And people just don't have that kind of visibility, because I don't think you two or any of us want to tell a business owner what to do. We want to help them clarify their goals and then help them understand how their decisions are going to get them closer to their goal or further away. Yeah. And the only way we can do that is by that kind of clarity.
So to kind of circle back to Stacy's question, though, I mean, do you have like maybe 1 or 2 or 3 very simple questions that should be asked of a business owner to at least jar them enough to where they may go, you know what, maybe I should look at this? Because, most business owners, as you know, because you were that guy, the head is, you're in the weeds. You can't see. You're so busy. You've got delivery vehicles that you're worried about, or you got your fuel bill, or you've got your materials you're dealing with, or employee problems and HR this and so all day long they're focused on everything as they are working in their business. Certainly not on it. Most of them are guilty of not ever working on it. But like, what would be a few questions that you should at least ask, or that we should ask, that would just be enough for them to go, hey, maybe I should look at this?
Yeah.
What's your goal?
What's your goal?
What's your goal? And if you say revenue, then I say, well, I had a $21 million business. It lost 940 grand. And if I would have sold the business, we would have owed the bank $2.5 million.
So that's
question. And then people go like this. Okay. Well, that was my goal. So now I don't know what to do. And,
right.
And so like, that's it. And now think about this is what is so, I find that myself blessed, because I love the fact that one of my biggest missions is to help people clarify the right goal. And then the financials just guide us to hit that goal. But have you guys ever been in the gym and seen someone walk in for the first time and have no plan? They're just like, they're going to machines. Yeah. Thomas, like me, they go to a machine, and they're like, you're just like, what are they doing?
Yeah.
And so like by not
I'm
having
working out.
I'm like, exactly. I'm being a business owner. What are you doing? I'm just putting fires out and buying things and hiring people and doing things. And I'm tapping my line of credit. What are you doing? Being a business owner.
I'm owning a business.
Yeah.
Exactly.
And don't you think that people, when they start their business, they have created a job for themselves, and job really stands for JOB, is just over broke. So
yeah,
they're
with
not-
all the personal guarantees, Stacy, of all that
With all the
stuff.
stress, the
Yeah,
sleepless
and-
nights, the discussions at the dining room table over dinner that the kids never want to hear.
Yeah. Well, sorry, Thomas, hold that
Go
thought.
ahead.
Is I think the number one way to solve that problem, to get that company that's managing itself, like when I watch these business owners go through our training program, they get this. So what ends up happening is the first thing. So Dan Sullivan, strategic coach, talks about the 4 freedoms: freedom of time, freedom of money, freedom of relationships, and freedom of purpose. We can't have these other 3 if we can't get time back. And the way that the business owner needs to get time back is that job versus the asset. If we're consumed by fires all day long, we're not going to have enough time to think. And we need time to think, because as a business owner and leader, our decisions have a ripple effect that it uses time, capital, and energy in a leveraged way. So the ripple effect is huge. So we have to think. So the way to get free time is to replace your job first. And that's usually, Stacy, to your point, why people did this to begin with is, I want to wake up and do whatever I want today.
Right.
And these people have the opposite of that. And I've lived it. So the way we do that, and this is where the numbers become the way to do this and how. But like, if I hear another, like a lot of our clients run EOS or traction, and they'll sit in these, quarterly meetings or the annual planning days, and the owner's saying, I'm burnt out. And the EOS implementer goes, we'll hire an integrator for 200 grand. And I'm like, so let's just boil down these numbers. So if you're doing 5 million in revenue, you're probably finally pulling in 100 to 200 grand in salary. You got your line of credit tapped, everything's, personally guaranteed. And then someone just randomly says, hire someone for 200 grand. You're like, I want to make 200 grand, let alone hire for someone. So they have to still pay their bills, their mortgage, their college tuition. They need the 20 grand net a month, whatever it is. So the way to think about this is we say, hey, what's the target equity valuation? So the cash flow target, so net income and normalized EBITDA in the future. And we build that plan. We can say, hey, Thomas and Stacy, if we build this plan, you can afford, Thomas, your $20,000 a month in distributions in month 9 of this plan. Then you hire your CEO for 20 grand a month. Then you can take a step back and think. And then that CEO is tied to the KPIs and the financials to that valuation. So you can actually manage them from the beach because the numbers are tied to a plan. But I think that freedom of time and decoupling themselves from their job is usually the first initiative. And I got people that are making 5 million in EBITDA, literally an HVAC business owner of ours doing 5 million in EBITDA. And he was doing the call center in winter because he was so busy. I mean, you guys making $5 million a year.
Well, you had me at running it from the beach. So we'll start there. But yesterday, Ryan, you were talking about three, our niche is tax planning, tax strategies, tax credits. And, we talked about, and I'll let you run through these, but the 3 tax things that if we don't have the first one, how do we do the second 2? And I'd love to expand on that.
Yep. So what Stacy's talking about is, in order to do correct advanced tax planning, the way that Lifetime has bucketed it out, and I love how Lifetime's done it, is through 3 ways of doing tax planning, which your annual income tax planning, then your capital gains tax planning, and then your estate long-term tax planning, like the death tax. Yeah. Okay, so you've all heard me talk now that my dad and I were running a $20 million business off of annual taxes, right? So we were driving our net income down as low as possible, not investing in the business. So we were only doing one of those 3, Stacy, to your point, and very poorly because our CPA would only give us 10 days notice before we owed the $450,000. And we'd have to put it on the line of credit. And
that's the best, by the way. I love it when they do that.
They're like, hey, Corey and Ryan, you did really well this year.
Take a bonus.
And take a bonus. And we're like, wait a second.
I love those bonuses. They go straight to the government and they're so rewarding. You really feel great.
Brainsky Unleashed is powered by ProfitMax. Did you know that 93% of businesses overpay on their taxes? Do you pay too much in taxes? A recent study showed that businesses are overpaying between 34 and 71%. ProfitMax is proven, legal tax strategy solutions to reduce your tax burden. I'm not only a client, but I even joined the team to help other business owners just like me pay only their fair share and nothing more. Go to profitmax.co. That's profitmax.co. Profitmax.co to find out more. You can even connect with me there, as you should. And I'll help make sure that your tax bill is legally as low as allowed. ProfitMax. Keep your cash.
And it's the bonus you don't have any cash for. So the CPA says you did really well. You owe 400 grand. And I go, with what cash? So
Horrible.
I digress, but back to your point of the three, it's the annual tax planning, which is the opposite of what we just described.
Yep.
And there, it should be proactive. And if you have that target equity valuation with the cash flow statements projected in the future, you can see your estimated taxes every single month. All of our clients have that. Like, it should be no shock. Swipe the taxes, put it in a prepaid checking account. You never have to worry about it. You can still hate them, paying them, but like, it's not at least a, horrible experience. So the second two that Stacy mentioned of capital gains and long-term estate tax planning, that is based on an entire balance sheet. So if I think about, Thomas, if you and I were going to do the advanced tax planning for Stacy, we would have to know, Stacy, what do you own now? And what will it be all worth in 2030? So if you own houses and cabins and cars and companies and investments, what are they worth right now? And what are they worth in the future? Because the investment will grow in value. And then you have to pay capital gains on those investments in the growth. And weird, your business, as we've all covered, is an asset. So if we have the biggest piece of the pie of the personal balance sheet and the cash flow that we are just guessing, how in God's name can we do capital gains tax planning? And then the estate tax planning is even more complicated, because we have to say, hey, Stacy, if you're going to be worth $30 million in 2030, right now you're worth 15, but your company's accelerating with growth. You've got a couple of investments in real estate. We want to do the correct annual tax planning between now and 2030, while also looking at the individual capital gains growth in each of those assets: real estate, privately held businesses, maybe some passive investments, the capital gains taxes on each of those investments, and then the holistic wrapper around your overall net worth, which is your estate planning, the trust, irrevocable, not irrevocable. All of that has to do, and it needs to be done with inside of the visibility of the company. And here's why. I have worked and onboarded clients where they had a rock star estate tax planning. Like, it's like, truly, if you get a tax attorney that's doing estate planning, they're in the 1% of their profession. But if they're only doing your estate plan for today and the business grows, I have true story. This company, this family, the parents owned this business that was crushing it. They were, I can't remember what the valuation was. It was a lot. So they put 70% of the shares of this company that was worth like $100 million into this irrevocable trust. Okay. The kids were the beneficiaries of the trust. Well, because it was irrevocable, the parents were still obligated to pay the taxes.
Oh.
So now listen to this stuff. So literally, the parents were the parents were obligated to pay the $3 million tax bill on the cash flow, because the company still had to pay the taxes. So they went and said, but yet the trust owns 70% of the shares. So they couldn't make enough to pay the taxes. So then they went back and they wanted to gross up the distributions to pay the taxes. So they wanted to take it from 3 million to like $4 or $5 million. But the bank said, no, you're going to trip your covenants. You're not allowed to do that. And we don't care that your estate planning sucked. Oh, wow. It gets even better. They got an offer to buy their company for $100 million. And the parents' 30% was the tax bill. So they said no. And now the company is worth $65 million.
Oh,
so rock star tax plan. But no one was looking at what the heck is the value of the company today? What's it going to be worth in the future? How do you deal with the trusts, the taxes, and the cash flow all at the same time if people don't do this holistically? So Stacy, back to your point, annual tax planning, got to get that covered. People are generally doing that, but they have a poor experience with their CPA. Then you do
Right.
the capital gains tax planning individually per entity or per asset. Then you have the overall estate tax plan that has to look at every entity. What's it worth now? What will it be worth? How to handle then irrevocable trust, revocable trust, ning ding, all those different things. And then the cash flow and taxes between now and then. Without doing it holistically, you're going to, I mean, I see those kind of stories every single, that was a dramatic one, but like, you see how all that fits together?
Well, Ryan, let me ask you this, because you just said something, and I kind of want to go back to it. CPAs and accountants doing tax planning. From your experience, and I mean, you've obviously dealt with a vast array of high net worth individuals and businesses. You're very keyed into that. How many of these CPAs and accountants are actually properly doing tax planning for their clients?
I'm struggling right now because I like, let's put it this way. I'm gonna do a little asterisk disclosure for everybody listening in. I believe that there are 3 to 5% wonderful individuals in every profession, whether it's real estate, whether it's CPA, wealth management, investment banking, brokerage. There's like the 3 to 5% of awesome rock stars at the
3 to
top.
5% is a big number, as we know.
I think.
And I'm just gonna leave it at that. And most times people are dealing with not the 3 to 5%.
Right.
And like in here, I did,
but they don't know.
It's here's what I did. So I'll speak to my own experience. I was a copier sales rep that got a D in accounting. Now I teach finance to investment bankers and CPAs and commercial bankers and business owners. So there's obviously something there. So, and it's because it's practical knowledge. And the thing is, I always ask people, have you ever met a CPA? Because CPAs, the job of the CPA is to move numbers into a box to pay the least amount of tax as possible, right? That's their job. I mean, and then they do quality of earnings if there's going to be a transaction or there's audits or reviews to make sure that there's the right stuff in the inventory on the balance sheet, all to make sure that it's a historical account that everything's going the way that it should. And then I always ask the business owners that I present in front of is, how many CPAs have you come across where they know, I'm looking back up at the clock, it's August 1st, 2024, and the business owner needs to make a choice between payroll, taxes, buying extra inventory, or taking out a loan to buy a building. That is a trade-off. The constraint is money and working capital. How many people know how to make that trade-off? And how is that going to impact the distributions that the business owner wants? That's it. Like that is the main, like, so if we're all sitting here going, we're owners of a company and we want an extra 20 grand in distributions, we're going to ask the owners or the executive team, are you on plan? Do you have enough funding? Can we pay our taxes? Do you have enough working capital? Yes. Okay, give me my 20 grand. And if the answer is no, I need, it's the data. So it goes back to your point, Thomas. CPAs, that's not been their job, is to look at the future. And I feel bad for them because business owners like my dad and I, copier sales rep, everybody that was numbers people went into one junk drawer. We say our finance people, and it was accounting, pay, AP, AR, business finance, commercial banking, CPA, wealth management. It was numbers people. And then we just put them in there. And then we would just ask any of them, any numbers question, is assuming that they all had the answer. And there's different roles and different specialties for different things. So the role that I just talked about, that visibility, is the CFO versus a tax and tax historical taxes is usually a CPA. And then people like Lifetime who are doing the 3 tax buckets that Stacey's talking about, that's future tax planning. And you need to understand, like, the only way to get done future tax planning the right way is if you know how valuations work in each of the asset classes of real estate, commercial banking, or sorry, real estate, commercial real estate, business valuations. All of those assets are going to grow in value and they're all illiquid. And there needs to be some visibility in how all of that works as it relates to the tax plan.
That's awesome.
So based on everything we've talked about so far, let's say a business owner decides, I need to make a change. All right. But they don't go with our Kona. They're going to save money. Big mistake, by the way. they're going to go with something else. They're going to contact their CPA. They're going to have a conversation maybe with their tax attorney, and their CPA and their tax attorney are not going to talk. And they're going to make moves. Now, at what point, or what, I guess a better question is, what pitfalls should they be watching out for when they do this and they avoid you? Only, by the way, to end up probably having to come back and look at a company like Kona, which they should. And Stacey and I would be happy to help you with that, by the way, just saying. But what pitfalls should they be looking for? What are the red flags they should be looking for when they're not working with a company like yours? Something should stand out. You help them stand out and go, wait a minute, something doesn't seem right. I should stop.
There's a couple things I would say. One is that if someone's listening in right now and they're thinking about expenses, you're already stuck in the bad mindset. This is an investment, right? Like you don't randomly get given money. And like in the last, handful of years, that's kind of been disproven. But my point is, you don't randomly just get given wealth. So like understanding what creates wealth and what creates a valuable asset, that is your biggest asset, is your obligation. Like, I always ask people, like, you walk into a doctor expecting them to actually holistically plan for you. Yeah, right. Unless you need a new knee or you got some drug that you need, that's what you go to the doctor for. And you got, forbid, if you don't understand how your body works and what you need, you're going to get whatever the person gets in front of you. And it is the person listening in, it is your job to understand what creates value, so you can actually put the lens in front of what Thomas is asking. Is how do you spot the BS? Like, there's no other way. And like if one of my family members was having a bunch of problems a couple of years ago, congenital heart failure, they needed a new hip, a new shoulder.
Family doctor.
Yeah. And they went to the shoulder doctor, like, we're going to give you a new shoulder. I'm like, don't you think that surgery might impact the congenital heart failure? Like, just saying. Yeah. You're like, well, I'm the shoulder doctor. So my point is, the only way to know is to understand how this stuff works, which is why our Kona started with an education offering, so we can teach you how to fish. Because the reason that I actually am principal for, and in the starter kit, the Lifetime Advisors Intentional Growth Starter Kit, that should be what we're driving everybody towards. We have some sample videos from the Academy. And then there's a case study where I walk through on how to project out the equity valuation of a business. Good. And I use specifically, Thomas, a spreadsheet, because here's the reason. Paul Allen and Bill Gates either invented the spreadsheet in the 80s or stole the idea.
Probably stole it. But I'm okay with that. It's still good.
Yeah. I still love it. And it's still like the most used. So that's one. The second is double entry accounting. It was invented in the 1400s by the monks. I did not invent any of this. This is how the world works. Every business and every asset has an income statement, a balance sheet, and a cash flow statement. The monks invented it, and the spreadsheet made it easier. So I show it, Thomas, in the case study inside the starter kit, because here, to answer, going back to your question, if your employee, your CFO, your CPA, whoever you have managing this cannot build this, it is a them issue. It is a math problem and a knowledge problem. So you can either go do it yourself or you can't.
So let's stop there for a second.
Does that make sense?
Yeah. I'm going to stop you there for a second. Because doing it yourself comes with a cost, and people may not necessarily recognize that. I know that out of personal experience, being the guy who loves to just make mistakes because I'm saving $1. And so I'll step over the $10,000 to save the dollar, or I'll step over the dollar to save the dime. What do you think? I mean, based on some of the statistics that you've collected, and I mean, you are a very statistic driven guy. So what would you say people are probably going to throw away money wise while they're saving money, do you think?
I mean, like, do you go to the doctor and like argue with the doctor? You know what I mean? Like, my
mother does.
And now I kind of do too. So it's been on both sides of my mouth. But like, I'd say that if you're the one, because your point is very valid, because out of the 550 people that have been through the material, at least half of them are like, can I get that spreadsheet? I want to do that. And I'm like, you literally want to do that yourself? Like, I own a good chunk of our Kona, and I don't want to do that. And by the way, I'm not the CEO because I don't want to manage people. like, If you are the one that wants to be the CFO and the job you want for the W-2 paycheck that you have is the CFO or something like that, have at it, but hire the CEO who can build the plan. Like the job of the owner and the GM, CEO, whatever your president, whatever the leader's job is to clarify the goal. Where are we going? And by the way, if you don't clarify the goal, the rockstar key executives are going to leave. I speak, a third of the groups I speak in front of are key executives that have maybe a couple % or aspiring to own some of it. Every single one of them, like, and actually I made everybody last week fill out on a scale of 1 to 10, but they're not allowed to fill out a 7 because a 7 is a BS non-answer. So it's a scale of 1 to 10 with no 7. And they have to, and I force them to say, how aligned are you with ownership on the clear goal? And everyone laughs. And so people come up to me and go, well, the owner doesn't want to come up with the target equity valuation. Do you suggest that I jam my salary up as fast as possible because they're never going to have a goal? Or do you think I should go buy a company on my own and I should bail? So like the owners can choose to do it themselves, have the scarcity mindset, and good luck attracting the right people. If you have a good big vision and the equity target is a pie that's growing in value, these key executives create the value that you give them. It's the cheapest comp plan ever. It's a phantom stock plan, and it's tied to equity in the value of the asset. So like, if you don't want all that and you want to be the project manager and the sales manager, and then at night be the accountant and the bookkeeper, then I would just say the same thing I said to my wife, where like, she goes, I have a headache. And I said, did you take any Advil? She goes, no. I go, what do you want me to do about it?
So let me quantify it in a different way then. So understanding private equity, and I mean, I know Adam Coffey, but I like Adam Coffey, and I see he was a guest on your podcast. Good for you. I'd love to have him on mine. Adam Coffey is a brilliant guy. Anyone who doesn't know about Adam Coffey, you need to learn about Adam Coffey. When it comes to private equity, this guy is the ultimate guru with private equity. There's always a high probability that private equity will end up being the ones who buy your business. In today's environment, there is tons of private money out there. By doing it yourself, you are going to reduce or limit the value of the multiples. And when I say multiples, that's, I guess EBITDA, right? Normalized EBITDA, comes in multiples.
The way, I'll just drop it.
Go ahead, break it down.
The annual cash flow, which is the normalized EBITDA. So let's say it's $1 million in normalized EBITDA, which is the annual cash flow. The multiple is what that is times by. And the multiple is like, whether it's a 3, 4, 5, 10, all that represents is the number of years of annual cash flow that someone gets. And those number of years is based on the perception of risk of the future cash flow. So Thomas, if you said, hey, I want to buy Kona, Kona's $1 million in cash flow. You say, I'm going to give you a 3. Indirectly, what you're saying is, on year 4 and 5, I'm concerned, Ryan. The story doesn't add up. And to your point, if I have a CEO and I've got a rock star team and a strategic plan and a financial plan, I hand you a baton and I say, here's everything you need. You might give me a 7 because you're willing to wait 7 years for your money back. And the key executives, like you're talking about with Adam Coffey, that's the private equity playbook, man.
It is. It's a great book, by the way. I've read both of them. Fantastic. But that's what I mean. So if if people think that they want to do this themselves because they don't want to spend a little bit of money, they of course can, but the cost in doing so, at least the way in which you're explaining it, and I'm going to believe you on this one, especially knowing what I know from the private equity playbook, is the cost is actually not necessarily going to come from the upfront. The cost is really going to come on the back end when your company's value does not have what you really believe it should or could because you didn't do it right in the first place. And so if you think that you might be able to sell your company for 5 million, but private equity only gives you 2, it is because you didn't do it right. Does that make sense? Am I correct?
Yeah. And it's completely based. So the 5 versus the 2 million that you just talked about is 100%. No, okay. I shouldn't say 100%. It's a huge proportion of that is based on the sustainable, predictable, transferable nature of the future cash flows. So if there's one thing that anybody takes away from this podcast is the more sustainable, predictable, and transferable your future cash flows are, the more your company's worth. And the more you can prove sustainable, predictable, transferable cash flow through a financial plan, through a strategic plan, through comp plans with an executive team that are tied to the strategic plan, that are tied to the target equity valuation and standard operating procedures and client, customer service KPIs and a sales fund, all of that stuff just makes more sustainable, predictable, transferable future cash flows. And it takes investing in the business to generate a higher multiple because you de-risk the cash flow. So this is an investment mindset that people are getting with intentional growth, not an expense mindset. Here's a real estate example to hammer this home. If us three bought a apartment building that we wanted as an investment, and Thomas, you said, hey, Stacy and Ryan, I'm going to be the maintenance manager, and Thomas is the one that's going after work and on the weekends to fix the toilet, to go to Home Depot.
You really don't know me.
Well, so let's assume that you actually know what a tool belt is. So by the way, I'm the same way. I'm the same way. So in that example, you can choose to be the maintenance manager and the home or the maintenance for that property. The property managers charge roughly about 5% of revenue. They get a job. So you're saying, Ryan and Stacy, I want the job of the maintenance property management. Great. But don't complain to me that you have no time. Right. So like you could, or we could invest in a property management firm that's going to reduce our annual income, but it's going to increase the value of the property because it's passive, not active. And a business is the same way.
That's good.
That's excellent. Really well said. We do kind of need to wrap this up here. Stacy, do you have anything else? Do you want to ask Ryan, get on the record, force him into something, anything?
Our heart is for these small businesses, especially. They just don't have the guidance, don't have the wherewithal and the know-how. And then they feel like something is wrong. Like we've talked about, something's off. They don't know where to go. Who do I ask this stuff to? Right. So I'm grateful, Ryan, that we have this partnership with you. It's just going to change the complexion of people's lives and their businesses and the bottom line at the end of the day. So we are grateful. I don't know that I have any other questions to ask you.
I have a comment. I have a comment on that, Stacy, because I think, back to your heart about the business owners, the challenge that I've seen over the last 10 years of advice is business owners are going to these advisors, a banker, a CPA, a wealth manager, a broker, the individuals that they're practitioners. Also salespeople. Every single profession I just mentioned, there's a hybrid of you're a salesperson and you're a practitioner who has a alphabet soup of acronyms behind your name because you're really smart. But the challenge is those are the individual doctors we just talked about. It's kind of the same thing with the healthcare where we lost the general quarterback of advisor who is the relationship person. So when I met Lifetime and the partners, I was like, this model's going to work because what I have realized, because we have other partners that license our material, but what happens is they struggle because the business owner is sitting there talking about their problems. And what happens is so many times the advisor uses that as an opportunity to explain working capital or explain whatever it might be. And the business owner's going, I just want to go to my cabin. And
right.
Want someone to treat like Stacy. I think about myself 10 years ago. I just wanted someone who really, really understood us, what our goals were, and that understood and can communicate like a general contractor to all of those advisors who had my best interest in mind and didn't need to sell only one thing. And so when I think about what Lifetime's done is they've allowed you by putting all these providers in your network. So you, Stacy, can truly help the business owner accomplish or clarify their goals and stay on track. And you're not forced to sell one thing. You're helping them get the right person at the right time, at the right resource that's going to move the needle. And I just think that that's why this is actually going to work, because the business owners in other circumstances are buying the wrong thing. They're investing in the wrong strategy that gets them off track because the person that was helping them could only do one thing.
Agree.
So I'm going to just kind of piggyback on this. And I do want to clarify something for the audience. Stacy and I are with ProfitMax. ProfitMax is a partner with Lifetime Advisors, which is something that Ryan has said many times. So I want to clarify that they do a lot of the heavy lifting for Stacy and I with the company. So I want to be clear with that. But, I think there's a broader benefit Ryan, and I don't know whether you've contemplated it or not. It is something that I've been thinking about and trying to do for years. I've tried to just even teach kids, teenagers, people who are young in the workplace, 19, 20, 21, they're getting their start in life and they have no idea that it's possible to finish as a millionaire. And the thing that I really like about what you're doing is when you talk about the market and you talk about that 6 million, and then you expand on it for all of their employees and everything. The fact of the matter is, we do not have enough millionaires in our country. We don't have enough millionaires in the world. Yet it's not unachievable. It's actually very achievable. Right. And I like the fact that what you're doing is you're helping people become that. And if you want to look at the struggles of the world, right? So we have all sorts of problems that end up getting dealt with usually by politicians' promises.
Well, the inequality, Thomas, this helps.
It solves it. It does. Yeah. Would you need as much government? Would you need the safety net the size as it is if you had so many more millionaires in the world? Here we go.
Conscious capitalism.
Here we go.
It's my Bible of a book. If that little thing right there, that is essentially the graphic that I think represents like what we need to do. So the listeners, it's this upward spiral. If we help these business owners create more value, inequality goes down, the next generation can actually take it over because the cash flow's there. And there's all in principle 3 in the program, we talk about all the ways people can monetize it through ESOPs, private equity, internal transfers, family estate planning, all that kind of stuff. That's when you get to the end. But the growth happens in between now and when you want choices. And to your point, Thomas, I think it's our mandate. Like, we have to grow value. And here's I'll leave the listeners with this. A lot of this has been built because I have a major internal desire to understand how I fit in the world. That's just my deal. It's unbelievably it's inside and internal. And so what I realize is the only thing we're doing every single day as working professionals is we're waking up and helping someone grow value. Equity is the name of the game. It's the entire public markets. It's the entire private equity markets. It's the entire VC markets. And it's the entire mainstream. And those 6 million companies you're talking about, Thomas, the average age is 65 and there's not enough people. There's not enough. Yeah. Right, Stacy? There's not enough people my age.
Right.
Who have enough money or know how to run companies. So what we're doing is if we get as many business owners and their leaders and the next generation to understand how valuations work and how to grow equity value, the pie gets bigger and everybody gets more wealthy. And if the pie is getting bigger, we're not taking from each other, right? We're growing it. And that goes back to the phantom stock plan. If the pie is bigger, they're creating the value that they earn themselves.
One of the misunderstandings I think a lot of people just they can't grasp is the pool of money, right? So let's just imagine that we're dealing with a gigantic Olympic-sized swimming pool, and that is the economy, right? And a lot of people believe that if you take money out of the shallow end or take money out of the deep end and move it to the shallow end, somehow things are more equitable, and that's not the case. The key to actually solving the problems is to add more water to the pool, or to make the pool bigger and then add more water to the pool. I like the fact that you're doing this because it does in fact add water to the pool. So we might have to just take this episode that we've created here and call it Saving the World with Ryan Tansom. That might just have to be the episode.
Well, that's no daunting task, but thank you.
No pressure.
You're up for it. Game on.
So with that, I need to wrap it up here. If anyone likes what they've heard, you can also subscribe, and I do encourage everyone to look up, and we'll put a link into the show information, the description area of the show, to subscribe to the Intentional Growth Podcast with Ryan. Every episode that he has is packed with insight. He's had some absolutely spectacular guests. I've gone through and I've looked at who you've talked to. There's many names that I'm familiar with that just bring excellent insight. I've listened to several of your episodes. It's really excellent. Profit Max, again, happy to help. Profit Max and Ryan, we are going to save the world one business at a time. talk to us. It's time for us to turn you into that machine that allows you to sit on the beach while collecting massive checks, only to turn it over to private equity where everybody wins and the pool gets full. Thank you all for joining us. And Ryan, I'd love to have you on again in the future and kind of see how things are going. Maybe, as Stacy and I add to that client list of yours, so we can talk about just how much impact we are having together. What a partnership!
Love it. Well, thank you guys for having me.
Excellent.
Thank you so much, Brian.
Thanks so much for joining us.